Spotify Technology, ticker SPOT on the NYSE, the company that turned the music industry's fear of streaming into the world's largest audio platform.
Founded in 2006 in Stockholm, Sweden by Daniel Ek and Martin Lorentzon. 9,000 employees, 761 million monthly active users across 184 countries.
In 2006, Daniel Ek and Martin Lorentzon set out to build a legal alternative to music piracy. Millions of people were downloading music illegally. Spotify made it easier to stream than to steal.
The service launched in Europe in 2008 with a free ad-supported tier alongside a premium subscription, a freemium model that became the template for every consumer streaming service that followed.
Spotify launched in the US in 2011 with Facebook integration, driving viral growth that took the platform past 10 million users. The social sharing loop proved the freemium conversion engine.
In 2018, Spotify bypassed the traditional IPO process with a direct listing on S&P at $149. At the time, it had over 170 million monthly active users.
In 2019, Spotify acquired Gimlet Media and Anchor for a combined $340 million, pivoting from music toward broader audio and betting on podcasting as the next consumption platform.
The Joe Rogan exclusive deal, worth over $100 million, signaled intent to own premium podcast content. Spotify committed over $1 billion to podcast acquisitions and exclusives across 5 years.
2023 marked a turning point. Spotify posted its first operating profit in company history. The profitability thesis, that subscription scale would eventually absorb fixed music licensing costs, was validated.
In 2024, Spotify passed 250 million paid subscribers. Price increases in key markets were absorbed without a spike in cancellations, confirming the product's stickiness after 18 years of user habit formation.
Spotify generated 15.7 billion euros in fiscal 2024 revenue. Premium subscriptions account for 87%, 13.7 billion euros. Ad-supported revenue adds the remaining 13%.
The gross margin reached 28.1% in 2024, up 5.3 percentage points year over year. Operating income reached 1.4 billion euros, the first full year of sustainable operating profit.
Spotify's competitive moat starts with data density. 761 million users generate billions of listening signals daily. Discover Weekly, Daylist, and AI DJ are powered by a dataset competitors cannot replicate.
The creator platform creates a two-sided network effect. As artists release on Spotify first, more listeners follow. More listeners make the platform more valuable for artists, a flywheel that has run for 18 years.
On the competitive radar, Spotify leads on subscriber scale with 95 out of 100, larger than Apple Music, Amazon Music, and YouTube Music combined in dedicated streaming.
Netflix leads peers on margin expansion at 92, reflecting the difference between video licensing, which Netflix can avoid through originals, and music licensing, which Spotify must pay on every stream.
SiriusXM has deeper content in sports and talk radio but is largely US limited. Spotify operates across 184 countries, giving it a geographic reach score of 92, the broadest audio footprint ever assembled.
Spotify serves 761 million monthly active users across 184 countries. The platform hosts over 100 million songs and 6 million podcast titles, the largest audio catalog in the world.
Premium ARPU, average revenue per user, reached 4.97 euros per month in 2024, up 5% year over year. Price increases in the US, UK, and EU markets were absorbed without meaningful user loss.
Daniel Ek has served as CEO and co-founder since Spotify's founding in 2006. He studied computer science at KTH Royal Institute of Technology, but left to build startups before creating Spotify.
Before Spotify, Ek built an advertising technology company called AdVertigo and served as CTO of uTorrent, the file-sharing software that itself highlighted the consumer demand for digital media access without friction.
Ek has led Spotify for nearly 2 decades, navigating label negotiations, content acquisition, format expansion, and profitability transformation, making him one of the longest-tenured founders still running a major public tech company.
Switching costs compound over time. A user who has trained Spotify's algorithm for 5 or 10 years loses their personalization history when switching. making churn economically irrational as listening tenure grows.
Spotify took 17 years to reach its first full year of operating profit, and when it got there, it had 761 million users, 252 million paid subscribers, and a podcasting catalog that consumed $1 billion in content investment that competitors still haven't matched.
The margin expansion is the open question. Spotify's gross margin is 28%, still well below Netflix at 40% plus, and investors are betting on whether the music licensing cost structure will ever let audio streaming reach the profitability of video streaming. Spotify just posted record gross margins, record free cash flow, and a beat on monthly active users. Then the stock dropped nearly 12% the next morning. Today we unpack that contradiction.
The Q2 operating income guide came in at 630 million euros, down from 715 million in Q1. That 85 million sequential step down is what the market focused on, ignoring everything else.
But the underlying business is running better than at any point in Spotify's history. Gross margin hit a company record for the third consecutive quarter.
I'm Lana, I'm Hudson, this is Charged Alpha, and this is our full breakdown of Spotify's Q1 2026 earnings. The record results, the sell-off, and what comes next.
Coming into this quarter, the market was watching two things closely: user growth trajectory and gross margin expansion. Spotify delivered convincingly on both, then stumbled on the Q2 operating income guide.
Monthly active users hit 761 million, 10 million ahead of Spotify's own guidance of 751 million. That's a company record and the fourth consecutive quarter of MAU beats.
Premium subscribers reached 293 million, 3 million above guidance. Audiobook bundling within the premium tier is improving conversion rates from free to paid faster than expected.
Total revenue was 4.53 billion euros, approximately $5.3 billion, up 8% year over year. On a constancy basis, that growth rate was 14%. The FX headwind was real.
Gross margin landed at exactly 33%, a company record. 2 years ago, that number was in the mid-20s. The structural shift in the cost base is real, and it is accelerating.
Free cash flow hit 824 million euros, another company record. That's a 124% increase versus Q1 2025, confirming that gross margin expansion is flowing through to real cash generation.
What changed the narrative was Q2 guidance. Operating income at 630 million euros, down 85 million from Q1. Management blamed planned marketing spend. The market wasn't convinced.
Let's go through the headline numbers one by one. Monthly active users at 761 million represent 10.4% year-over-year growth, the largest absolute listener base in streaming history.
Premium subscriber count of 293 million reflects 12.3% annual growth. Audiobook bundling is a key driver. Premium users who access audiobooks churn at measurably lower rates than average.
Gross margin of 33.0% beat consensus estimates by approximately 60 basis points. The improvement is structural. Podcast exclusives are now amortized, and music royalties have been renegotiated at more favorable rates.
Operating income of 715 million euros on 4.5 billion of revenue equals a 15.8% operating margin, up from 9.2% in Q1 2025. That's 660 basis points of expansion in 12 months.
Free cash flow of 824 million euros versus 367 million in Q1 2025 represents a 124% year-over-year increase. Cash conversion from operating income is running above 90%.
EPS came in at $3.45, beating the 340 consensus by a nickel. The headline was clean. Every major line item met or exceeded expectations going into the Q2 guide.
Premium revenue totaled 3.97 billion euros, up 9.4% in euros, roughly 16% on a constant currency basis. Dollar strength against the euro created meaningful headwind.
Advertising revenue came in at 557 million euros, growing roughly 14% year over year. Podcast ad placements and branded playlists drove outperformance. Audio advertising is recovering.
Podcast economics turned positive for the first time this quarter. After 3 years of heavy content investment, the podcast segment is now generating positive gross margin, a key milestone.
AI features are at massive scale. The AI DJ personalized radio tool has 94 million monthly active users. Song DNA, Spotify's taste mapping algorithm, now covers 52 million tracks.
Balance sheet, 8.8 billion euros of cash and investments. Net cash positive, no meaningful debt. Spotify has the flexibility to buy back shares, make acquisitions, or fund aggressive product investment.
Q2 guidance, 778 million MAUs, 299 million premium subscribers, 4.8 billion euros revenue, 33.1% gross margin, and 630 million euros operating income, the soft spot the market focused on.
On leadership, Daniel Ek, who founded Spotify in 2006 and served as CEO for nearly 20 years, transitioned to executive chairman in January 2026.
Spotify named two co-CEOs, Alex Norström, who ran the freemium and monetization business, and Gustav Söderström, who built the product and R&D organization, including all AI features.
Ek remains the largest individual shareholder and retains meaningful strategic influence. This is an operational handoff to proven operators, not a founder exit.
The market read the transition as stable. No analyst concerns surfaced on the Q1 earnings call. The two co-CEOs handled questions confidently, and the narrative stayed on fundamentals.
Digging into the P&L, total revenue of 4.53 billion euros breaks down as 3.97 billion in premium and 557 million in advertising. Both lines grew year over year.
Premium revenue grew 9.4% in euros, approximately 16% on a constant currency basis. About 600 basis points of that FX headwind came from dollar strength versus the euro.
Advertising growth of roughly 14% exceeded expectations. Podcast inventory sold through well, and branded playlist sponsorships outperformed. Audio advertising recovery is tracking ahead of plan.
Cost of revenue, primarily music royalties and podcast licensing, represents approximately 67% of revenue, down from 72% 2 years ago. That compression is the story of the margin expansion.
Gross profit of 1.50 billion euros at 33.0% margin is the key deliverable. Operating expenses held relatively flat year over year at 783 million euros, while revenue grew 8%.
Research and development spend was 437 million euros, about 9.6% of revenue. Spotify is investing at the AI and product layer without proportionally growing sales and marketing headcount.
Interest income on the 8.8 billion euro cash position contributes meaningfully. At current rates, Spotify earns an estimated 350 to 400 million euros annually on idle cash holdings.
Free cash flow of 824 million euros compares to 367 million in Q1 2025, a 124% increase. Capital expenditure was under 50 million euros. Nearly all operating cash flow became free cash flow.
Annual subscription plan adoption is rising. Annual subscribers churn at roughly half the rate of monthly subscribers, quietly improving Spotify's revenue predictability and lifetime value per user.
ARPU is trending upward. Audiobook bundling in premium adds an estimated 1.5 to 20 euros per subscriber per month in markets where it's fully launched, a structural ARPU tailwind as global rollout continues.
The Q2 gross margin guide of 33.1% is higher than Q1. That overlooked detail is key. Operating income guidance was soft, but gross profit structure is still improving.
Full year 2026 consensus EPS moved to approximately $15 to $16 per share after the print, up from roughly $12 pre-earnings. The earnings upgrade cycle is intact despite the stock reaction.
Comparing Spotify to peers takes creativity. There are no direct public comps. Apple Music, Amazon Music, and YouTube Premium are all loss leaders inside much larger platform businesses.
Netflix is the closest trajectory analog. Netflix spent years burning cash building content scale, then pivoted to margin expansion. Spotify is roughly 2 to 3 years behind on that same arc.
On user scale, Spotify leads the streaming category globally. Netflix has 270 million paid subscribers. Spotify has 761 million monthly actives and 293 million paying premium subscribers.
Spotify's 33% gross margin looks modest versus software companies at 70+%. But software companies don't pay royalties. The correct benchmark is Spotify versus its own prior quarters.
Pandora, owned by SiriusXM, is the closest domestic comparable. Spotify's global scale, two-sided free plus premium model, and AI investment give it a structural edge in monetization per user.
The key competitive moat is data density. Spotify has 20 years of listening behavior across 761 million users. That taste graph powers AI DJ, recommendations, and advertising targeting at scale.
No competitor has replicated the Spotify experience at this breadth. Apple has the hardware lock-in, YouTube has video. Neither has the pure audio engagement depth Spotify's taste data reflects.
The primary risk is royalty cost inflation. Spotify's deals with Universal, Sony, and Warner are renegotiated periodically. If rates rise, the hard-earned 33% gross margin compresses immediately.
Currency is a persistent risk for U.S. investors. Spotify earns and reports in euros, but a strong dollar deflates the reported USD figures that American benchmarks and index funds track.
Operating income volatility is demonstrated by the Q2 guide itself. A single quarter of elevated marketing spend moved the line by 85 million euros, meaningful at this scale of investment.
Competitive pressure from Apple and YouTube has intensified. Both companies reinvested in music features and AI recommendation tools through 2025. The battle for listener time is global and expensive.
AI creates asymmetric risk. If generative AI disrupts music creation and distribution, enabling artists to bypass labels, the royalty cost structure could shift dramatically in either direction for Spotify.
Options activity spiked post-earnings on the 11% gap down. Near-term implied volatility was elevated, creating specific setups for traders around the Q2 operating income guidance uncertainty.
The advertising tier is macro-sensitive. Spotify's 557 million euros of ad revenue will contract meaningfully if global brand spending slows. A downturn scenario hits the free tier harder than premium.
The analyst community stayed bullish after the sell-off. Of 35 active analysts, 25 have buy or outperform ratings, 8 are neutral holds, and just 2 are sells.
The average price target across all analysts is $670, implying 53% upside from the post-earnings close near $437. Several analysts raised their targets after the Q1 print.
The 2 sell-rated analysts center their bear case on valuation. 40 to 45 times forward earnings is too rich, and any royalty cost surprise could trigger a 20 to 30% correction.
Goldman Sachs maintained their buy and called Q2 guidance conservative. Their model has operating income recovering above 800 million euros by Q3. They see Q2 as the sequential trough.
Morgan Stanley labeled the sell-off a buying opportunity with a $750 target. They model gross margin reaching 38% within 2 years. At that level, the current PE looks cheap in hindsight.
JP Morgan highlighted the MAU beat as the critical signal. 761 million users versus 751 million. Guidance means top of funnel hasn't slowed despite premium price increases in the US and Europe.
The full year 2026 consensus EPS estimate moved to approximately $15 to $16 per share after the print, up from roughly $12 pre-earnings. The revision cycle is moving in the right direction.
Bull case first. Gross margin is on a multi-year structural upward trajectory. At 38% gross margin, which Morgan Stanley models by 2028, the operating leverage at Spotify's revenue scale is significant.
Premium ARPU is rising as audiobook bundling adds meaningful incremental revenue per subscriber. A 1.50 to 200 euro per user per month ARPU lift translates to hundreds of millions of additional annual revenue across 293 million subscribers.
AI engagement tools are increasing session length and improving user retention. More listening time means more ad impressions on the free tier and higher lifetime value on premium subscriptions. Both monetize positively for Spotify.
Spotify has 8.8 billion euros of net cash and no debt. They could fund a large buyback, acquire a major podcast or audiobook platform, or sustain years of aggressive R&D without touching external capital markets.
Bear case. Operating income volatility is real and management-driven. The Q2 dip from 715 to 630 million euros is not structural, but if investment cycles extend, the operating leverage thesis gets delayed by years.
Valuation risk is significant at 40 to 45 times forward earnings. As we just saw, a single guidance miss can erase 10 to 15% of market cap in one session, with no fundamental deterioration in the business.
Royalty concentration is the structural bear risk that is hardest to model. Three labels control the content defining Spotify's value proposition. If negotiations shift against Spotify in the next round, the 33% gross margin could reverse quickly.
Bottom line on Spotify. Q1 delivered on the metrics that matter most. Gross margin at a company record, free cash flow at a company record, and MAU growth 10 million ahead of guidance. The Q2 operating income guide disappointed, but gross margin guidance of 33.1% is still a record. The business structure is not deteriorating. Investment spending is elevated. That is a different problem than a broken model.
For long-term investors, the 11% drawdown is the market repricing one guidance line, not the fundamental story. Gross margin at 33% and guided higher in Q2 is the pillar this thesis rests on. 35 analysts hold an average target of $670 against a current price near $437. The street has not changed the call. Watch Q3 operating income. Goldman expects a recovery above 800 million euros.
Charged Alpha is an educational commentary podcast. None of the content here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. We do not hold positions in securities discussed on this show. Always consult a licensed financial advisor before making any investment decisions. Securities mentioned are for educational discussion only and are not buy or sell recommendations.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.